Hi, this is Dr.S.VALLUVAN from MBA, Dr.S.VALLUVAN College of Arts and Science. Welcome to the next video. Types of fundamental analysis. And how to do a fundamental analysis of a stock. These are the steps to start a fundamental analysis of a company. In a nutshell, understand the company and its operations and the business model. Once before doing the fundamental analysis, first you want to pick up the sector in which you want to invest your money. And then the industry and then the company. You have to understand the company and its operations. What sort of business or what sort of products or services that the company is manufacturing or rendering. Whether the company's size is small or medium or large. The type of product they are manufacturing. Whether they're producing discretionary items or non-discretionary items. So everything should be analyzed. And of course the operations of the companies. Then the business model. What is the product? Who is the target customer for the company? What are the sources of revenue through which the company earnings? Their suppliers, their creditors. Simply the blueprint of a business is what we call the business model. Then use the financial ratios for initial screening. There are some important ratios are there that must be calculated and that must be analyzed. For example, profitability ratios and solvency ratios. And return on capital employed. These are all very important ratios that must be analyzed. Then closely study the financial reports of a company. Find the company's competitors. Who are the competitors for the company? And you have to study the competitors also. What they are manufacturing, what is the pricing strategies of them. And check the company's debt and compare it with the rivals. Work it for debt equity ratios. Check the solvency position of a company, whether it is a short-term solvency or long-term solvencies. Analyze it and compare it with the competitors of the companies. Then analyze the company's prospects, future potentials and all. Here's some example of fundamental analysis. So the first step is to do a qualitative analysis of the business, which we saw in the first class, the qualitative analysis of the business. We have to check the products, promoters and the competitors of the company. We can study the mission and vision and the values of the company on their websites. And of course the quality of the management also. Then checking the financial ratio, which we saw earlier. These are the important ratio other than the profitability ratio and solvency ratios. EPS, earning per share. Increasing the EPS for the last 3 to 5 years is a good sign. PE ratio, price to earning ratio, is the lowest among the industry peers. Price to earning ratio tells whether the company's particular stock, whether the particular company's stock is expensive or cheaper. Then return on equity, average 3 years or less than 15% is preferred. Debt to equity, less than 0.5 is preferred. There is a debt. It talks about the debt of the company. Then current ratio, greater than 1 is preferred. Liquidity, it shows the liquidity position of a company's. Then past financial results of a company. Then competitor analysis. Comparison of a company with its peers in the industries. We can check the USP, unique selling proposition competitive advantage, product costing, product pricing, brand value, future strategies of our competitors in the industry. How to do a fundamental analysis of a stock is to check the total debt of a company. That is a main answer for the questions, which means how much money a company owe to its creditors. After analyzing all these factors, we can arrive at an intrinsic value of our ABC Limited company, for example, and decide whether it's undervalued or overvalued. Fundamental analysis provides long-term perspective and helps investors make informed decisions based on company's intrinsic value rather than short-term market fluctuations. Thank you.